Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a recent Citi research report focusing on Microsoft Corp. That's MSFT.O.
That's right. The report came out August 13th, 2025. It's titled, Effective Price Hike Should Be a Modest Tailwind to PVP Growth.
Okay, Citi, so what exactly are they analyzing in this report?
They're looking closely at Microsoft's recent SaaS pricing update, Software as a Service. This update is set to take effect November 1st, 2025.
And the headline change is?
It removes the volume discounts previously available for enterprise agreement deals, the EA deals.
So the large corporate customers, the ones on those multi-year EAs, they lose their bulk discount pricing.
Essentially, yes.
Wow.
It standardizes the prices for their online services across what they call price levels A through D. Basically, it aligns everything with the public pricing you'd find on Microsoft.com.
So this hits when agreements renew or when companies buy new online services?
Correct. But it's important to note what it doesn't affect.
Yeah.
Citi makes it clear this doesn't apply to on-premises software licenses, and it also excludes the U.S. government and the worldwide education price lists. Those remain separate.
Got it. So focusing on the financial side, this kind of price standardization, even if it seems small, must have a noticeable impact for a company like Microsoft. What are Citi's projections?
They estimate it could add about 1.6 points of incremental growth. That's across Microsoft 365 and Dynamics 365 specifically.
And those are pretty significant parts of the business, right?
Oh, absolutely. Together, they make up over half of Microsoft's product and business productivity segment, the PBP segment. Citi did some what they call quick math. They suggest it's roughly a 1 to 2 point annual uplift for M365 and D365 combined.
Okay, 1 to 2 points annually.
Though for the fiscal year 2026, the impact will be slightly less. Because it starts November 1st, it only affects about, 2.75 quarters of that fiscal year.
Right. The timing matters.
It really does. And, this whole move really highlights Microsoft's pricing power once companies are embedded in their ecosystem.
It's hard to switch. Very sticky.
Exactly. The switching costs are high, giving them this kind of leverage.
So let's talk investment outlook. That's what our listeners really focus on. How does Citi view Microsoft shares given this, and what are the main risks they flag?
Citi is maintaining Microsoft as a top pick. They have a buy rating on the stock. Their one-year target price is $680.
$680. That implies a pretty healthy return.
Yes, they calculate an expected total return of 31.2%. That does include the dividend yield, which is about 0.6%.
Small yield, but part of the total return picture.
Right, and the valuation they're using is based on a 31 times price-to-earnings multiple. That's applied to their forecast for fiscal year 2028 earnings per share, which they peg at $24.54.
A 31x multiple is quite strong. What's the justification?
Citi points to Microsoft's durable growth profile and, importantly, its leadership position in the whole generative AI space. That's a big factor.
Makes sense. But no investment is without risk. What does Citi see on the downside?
Well, there are a few key risks they identify. One is the possibility of an aggressive ramp-up in capital expenditure for Gen AI.
Spending heavily on AI infrastructure.
Right. If the customer adoption ends up being slower than they anticipate, that spending could hurt near-term margins.
Okay, what else?
Intense competition, naturally, particularly in a hyperscale cloud market. You got AWS and GCP fighting hard.
Always a battleground there.
And the third main risk is potential earnings dilution from a large acquisition. If Microsoft were to make a really big buy, it could dilute earnings per share in the short term.
Understood. So, moving beyond the markets for a moment, how might a corporate pricing strategy like this, removing volume discounts for big clients, actually affect the general public?
That's an interesting question. For the average person, the immediate impact isn't direct, of course. But think about the businesses and institutions that rely heavily on Microsoft's enterprise cloud services. Universities, hospitals, large companies.
Their costs go up when they renew their deals.
Exactly. They'll face increased operational costs. And, those costs often get passed along. So it could indirectly lead to slightly higher prices for the products and services that those businesses offer to their customers.
So a ripple effect through the economy.
Precisely. It shows how a major corporate pricing decision, even one focused on enterprise deals, can eventually filter down and subtly impact consumers.
It's a good reminder of how interconnected things are. As these tech giants continue to exert their market power through pricing strategies like this one, it's worth considering how that shapes not just their own financials, but the broader economic landscape and maybe even the direction of innovation for businesses everywhere.